I'm Virginia Graham, author of Flirting with Finance and host of The Intelligent Property Investor. Each episode, I sit down with experts behind the real property decisions, from buyer's agents to legal specialists to finance specialists, to uncover the smarter ways to approach buying, financing and managing property. Today, I'm joined by Luke Clifford and Lachlan from Atlas Property Group, two of Australia's leading property investor strategies. Welcome, guys.
Hello. Thanks for having us.
So, I was wondering, who do you help and how do you help them? What sort of investors?
So I would say for us, we really focus on helping time-poor professionals and business owners who are looking to create strategic property portfolios, but they don't know how to go it alone. They don't want to go at it alone. And for them, they're really focusing on how can we be as strategic as possible and build and generate long-term wealth so that when they get to the end of their working lives, they're not sitting there and just having to rely on a pension as their source of income.
Yeah, we certainly help investors that want to take a very strategic, data-driven approach to property investing, not people that are wanting to kind of just shoot from the hip and buy anything that looks good at face value, something that's got an actual strategy and substance behind the purchase.
Okay, and what are the main strategies that you sort of would think about for an investor, a new investor?
For us, I think the main strategies really come down to thinking about what is the client going to achieve, because the strategy has to fit the outcome. If we create a strategy that isn't to fix the problem they're trying to solve, everybody's going to end up unhappy. So we have to really sit back to think about, is this client trying to generate passive income? Is this client trying to retire early? Is this client trying to set something up for family when they maybe pass on and they want to have that generational wealth?
Yeah.
For us, it really is about what's the outcome, and we will then create the strategy. And for us, we really focus down on what is the right property type at the right time of the portfolio so that we can then help them to uncover that.
Yeah, absolutely. I think something that we find that our clients really, really love is the very first part of the process when a client comes on board with us, and this is prior to us looking at locations or property types or anything like that, is we'll sit down with the client, we'll run through their finances, we'll work with them in determining what their goals are, what kind of time frame they're hoping to achieve those goals in, and then off the back of that, we'll build out the client their property acquisition plan. Right? So that's the first part before we actually go out there and try to find a property for the client.
So do a lot of clients sort of stay with you for life then?
Well, fortunately, we haven't had too many clients who have had to go to the end of their life for us. So, so we're not at that stage yet, but we have a lot of clients who have been with us for a long time. We've built out from the very beginning of their portfolio to now where they own multiple assets. And for us, it's fantastic because we really become a trusted advisor. And in a lot of cases, a friend, sometimes a mentor, but somebody that they know that they can call or email and have that tough conversation no matter what's going on, and know that we're there to support them to get them to their next milestone.
Yeah, that's absolutely our business model. Like, if we ensure that the client has a great experience, but also ultimately deliver them performance with the property, there's a very good chance that they're going to want to work with us again, or at the very least, refer us to friends and family and things like that.
Yeah, that's good. And what are 5 things that your ideal clients don't know that they don't know?
I'll go the first one. So I think coming off the back of what I was saying before, sequencing is absolutely critical. Too often we see people who buy what might not be a bad property, but it is at the wrong time of their portfolio. And that means that then suddenly, instead of them being able to scale into multiple assets, driving towards their goal, maybe they're stuck and unable to invest for another 5-10 years at a minimum. And it's all because they didn't get the sequencing of properties right.
Yeah. It might be like a good property, but it might be just at the wrong time.
Yeah.
For example, they might buy something like a duplex that at face value looks good, but if it's not achieving them a beneficial level of growth, it might slow them down in terms of expanding. Right? So I'd say that's probably the first one. The second one, I think there's a lot of investors that don't necessarily understand how lending works at an intimate level. So they'll go out there, they'll get their pre-approval, and then they'll just go out there blindly and buy in their own personal name without thinking about the next step beyond that. So And I think they also don't realize how quickly borrowing capacity can dry up. So it's about being really strategic about how you actually go about structuring those loans. So having a broker partner that does take a very investment focused approach
And strategic.
Yeah, exactly. Yeah,
Yeah.
absolutely.
So I think probably the third one that sticks out in my mind is the cost of underperformance, or thinking of it a different way, the cost of an opportunity cost, right?
Yeah.
So, there can be a huge difference between a property that grows at 4 or 5% per year versus a property that grows at 7 or 8% over a year, right? And that's just in 1 year. When you go and extrapolate that over 5 years, 10 years, 30 years, when you're building out a portfolio, that is a huge cost. And then equally so, that's the long term. In the shorter term, if you buy a property that doesn't see performance in the shorter term period either, you can then, it's like the old super ads, compare the pair. You can buy the same property and after 30 years, it's likely to have grown, at a very similar percentage value, right? But the difference being, if you can front load some of that performance, you can then jump into your second, your third, your fourth, your fifth. So when you do that old compare the pair, you got one person over 20 years who might own 2 or 3 properties versus another person who might own 8 or 10 properties, all because they sequenced correctly, but they understood opportunity costs.
Yeah, and also there's the compound interest, really. Isn't it?
Exactly right.
Yeah,
Compounding interest in it.
absolutely. And then I think the fourth one,
Yeah.
getting ahead of myself here.
Yeah.
The fourth one, data without context can be really, really dangerous. I think data is a bit of a buzzword that a lot of people hear. They're on online forums, the Facebook groups. Everyone wants to use data to buy a property, but data in isolation can actually be quite dangerous. So first of all, you need to have context around what the strategy is, right? Because if you're looking at data to try to find a market that's more cash flow focused as opposed to growth or a balanced approach, you might not get the outcome that you're looking for.
Yeah.
Right? Anything to add there?
No, I couldn't have said it better myself. So I think that for me, the final piece of that puzzle is not just what's your exit strategy, but what's your holding strategy?
Yes.
Because property is a long-term asset. No matter how active we want to be, there is going to be periods where you really are just holding an asset. But if you put your head in the sand and you just think, I'm holding the asset, there's nothing I can do, I'm sitting back, you're going to miss out on a lot of opportunities. It probably links into what I was saying on that point before, your one around opportunity cost. It could be down to things of, have you reviewed your loan? Are you getting the sharpest rate? Have you reviewed your equity? Do you have potential to move forward? Have you conducted any value adds or improvements to your property to increase the performance and the equity? The list goes on, but holding doesn't just mean waiting and doing nothing. Holding still requires active effort, active consideration. And the people that do that are the ones that succeed the most.
Yeah. Couldn't agree more. And I think the other thing is it really depends on what your goal is as well. And for example, SMSF property investment, which is something that we are very heavily involved in. As a lot of listeners might or might not know, you can't pull equity out of an SMSF property. So in terms of scaling the SMSF portfolio, it can become really, really difficult. So what some people might look to do is they might try to ride the markets. And what I mean by that is they'll try to get into a market that experiences beneficial growth over the first, say, 12 to 48 months, and then may look to liquidate and then repurpose funds across multiple, right? So really depends on what the goal and I guess what the
Strategy.
the strategy is for that client.
Yeah. It's funny because do you get people only buying investment properties and self-managed super, or do you do business real property as well?
Business real property.
That's commercial. Yeah.
No,
Where
it's-
they buy their own.
Yeah, no. So for us right now, that's not a big focus of ours. It's something that we're definitely currently expanding into and going to continue expanding into. And it's a massive opportunity, marketplace opportunity, because there are lots of an accounting firm that's stayed in the same office the last 10, 15 years, and stay in that same office for another 10 or 15 years, and it might make a lot of sense for them to purchase that office for them to hold, right? So there is a massive gap in the market for activity like that for sure.
Yeah. And so with the super fund properties that you do, what's the sort of overall sort of strategy for that?
it really comes down to what the client is looking to achieve. Most of the time, it is more of a buy and hold just because of the red tape that's around SMSF property investing. But those that are wanting to expand, like I said before, it might be looking to ride those markets, to sell, pay that 10% capital gains tax, and then repurpose funds across multiple from that point. That might be an approach for somebody. What else will we do?
Well, I think you said it perfectly, and it's a classic answer, but it is so dependent on the client. And of course, we can't give that advice around what you should or shouldn't be doing in super. But when someone comes to us to say, I've already had that advice, and the advice has been property could be a good avenue for you. Can you help me buy property? That's when we can come in and, take that piece. But at the end of the day, for a lot of people, the benefit of something like super investing through property, is that you can leverage your returns, and you can do it in a far safer manner than, for example, the share market or other activities. So for a lot of people, if you bought a $500,000 property, you put down 20% deposit, so you got $400K of debt, 10, 12 years, it's now worth $1 million. Let's just say you've paid very little of that loan off. Easy math, since we're just thinking about it on the fly. Let's say you had the whole $400K remaining. You've now got an asset, you sell for $600,000, you pay a little bit of gains. You've probably just generated the better part of $500,000 worth of gains. And for an average person, do you really think just through your standard contributions and then some, even 10, 12% in a share market?
Say maybe 8.
Exactly right.
Yeah.
Are you going to generate $500,000 in 10 or 12 years? Unlikely. So all in all, I'd say if I wrapped it up, it comes down to the client, but stage of life and the advice they've received from their professionals.
Yeah. And for the super fund properties, because you can't improve them, I think, generally.
Yeah.
Because there's a lot of red tape around them. The sort of properties that people are looking at then sort of newer ones, or are they?
I wouldn't say so. I think that at the end of the day, you can still conduct repairs. Like if your property breaks, and you don't end up stopping and saying, "Oh, it's in super, I can't fix it up" or anything. You're just a lot more limited in the improvements you can make to the property. But at the end of the day, if you're looking for performance, it is shown. You can prove it mathematically. You can prove it through the data.
Absolutely.
Established property outperforms new property every day of the week. It's twice on Sunday. So for a lot of clients, they actually get sucked in to some of the fancy marketing around house and land packages and off the plan type stuff. And probably won't talk about
depreciation.
Depreciation. Exactly right. But at the end of the day, if you've got a property that is performing better and growing better, you are likely buying an established property. And that's what a lot of our clients like to do.
Yeah.
I have to ask you other questions. What mistakes do you commonly see when investors try and DIY their own portfolio?
I think shiny object syndrome is probably
I'd agree.
one of the things. So, and I personally typically see this amongst investors that are a little bit later in life, and this is anywhere from say 45 to 55 and beyond, where they might have felt that they've left things a little bit too late. And now they're looking at things like asset types such as these alternative residential type of properties like NDIS or co-living that are relatively new. There's not a lot of data and evidence to support that they're good, sustainable property types. And they're inherently a lot riskier as well. So that's typically what I would see, especially with that older kind of demographic, I would say.
And I would say probably not using their resources properly, right? So, for example, that could be loading up on debt to buy the wrong properties, right? So you've already got two issues there, probably overloading on debt and then also doing it on the wrong properties. But then it could be down to not using the resources of their professional advisors around, like their accountants or financial advisors, brokers, buyers agents, whoever it might be. And we see this a lot with professionals and business owners, the wrong structures that come out of it. So they might have aspirations for, very big goals, very big outcomes, but they start in the wrong structures, or they get one or two or three properties down the road, and then they realize maybe they've hit a roadblock, but it's very time intensive and costly to unwind those mistakes, to restructure properly compared to just doing it right from the beginning.
Yeah. But tying into what I was saying before with these alternative type of properties, some people overcomplicate things, especially early on their journey, whereas it's really, really important to set things up right from the start, get a good asset that's going to build that equity base really efficiently. And if you're bringing kind of emotion into the equation with a lot of the purchasing that you do, it's inevitable that you're probably going to slip up and make a mistake along the way.
I've seen that too, where you get someone and they'll have quite a good strategy. Like this is just I've seen from the point of view of friends, and they'll say, for example, their strategy might they just buy a whole lot of studios or one bedrooms or something,
Sure.
and then they do really well out of it, but they get bored.
Yeah.
And they get like boredom syndrome or something, and they just sell them.
Yeah.
And you'd be like, if they just held them, they would have been fine.
Yeah.
But they get bored.
I think, well, like Luke said, shiny object syndrome. It's,
Yeah.
I think we very much live in a world where people want big instant sugar hits. People want to showcase something sexy online. They really want to be seen like there's something that maybe they aren't, but they don't need to be anything else. They're doing very well as they are.
Yeah.
And it then ultimately costs them time, costs them money, and it costs them the outcome.
Yeah.
But I think a lot of people feel like they want to fast track things. Like I was saying, if you're 55, 60, you're heading to your retirement years, you're like, well, I need to try to set myself up with some kind of passive income stream.
Yeah.
So they might go and invest something like a co-living where initially you might be getting some decent cash flow, but if it's not growing on the other side, you're not getting any growth. And if something does happen to the cash flow side of things with that co-living, you're now stuck with a property where you're not getting the cash flow returns that you were hoping for. And now you've got another property that's not growing. It's probably going to be hard to sell.
Yeah.
Trying to offload it, which can make it a bit of a tricky spot for the investor.
Actually, that's a good point. There's a lot of properties that are hard to sell. And when they buy them, they like studios that are too small, or else company titles in areas where there's some problem, and people don't seem to know there's a difference between the titles and the different.
People can be very uninformed. It's probably what I'm sure all of us have seen over our property careers is I think sometimes we can get lost in the fact that we deal every day in it. We forget that other people don't, and that base level of knowledge is actually not as high as people think it is. And that's okay. I'm sure they have a very high base level of knowledge in whatever it is that they do, right? Whether they're a nurse or a teacher or a lawyer or whatever it might be. But when it comes to this, we often think that because we live in property and we're around property, and you walk down the street and you're surrounded by property, that you inherently understand it at a much deeper level than what people actually do.
And the other thing too is, I think that's true. The other thing too is that I think the average person is probably actually smarter than you think, but not at the things that you necessarily would think.
Mm-hmm.
And a lot of my earlier clients when I first started my business were actually in financial services. And a lot of them just did not know how property worked.
Yeah.
They really didn't. They didn't understand how loans work, they didn't understand how property works. And some of them were very higher in
We see that as well.
Intelligence doesn't substitute knowledge. And you can have very smart people, and yet they're blowing their money on supercars and holidays and depreciating assets and all the rest. And yet they are at the absolute top of their field of whatever it is they do. So I was
But even in finance, which surprised me. And that's, in fact, why I ended up writing that book, Flirting with Finance, was because there was so many women in particular in those days, this is a while ago now, just did not have basic financial literacy, even working in finance. And you're thinking, well, if these people don't know, and they're smart people, they're very highly intelligent. That's why I think this, and I think that's what this is for intelligent people that don't know this.
Yeah. Was it? Everyone is very good at giving advice, but we're all usually pretty poor at taking our own advice.
Yeah, that's true. So how do you use data differently compared to traditional methods?
So I think that the way that we use data and just the use of data in general has changed so much.
Yeah.
We have never had more access to information and to data than we do today across everything, but most definitely in property. And I think that what has resulted from that is that the people that know how to use it are they're getting the best results, and they're going to get the best results they ever have. But the problem with data is that it is not a one size fits all. And you can have access to all the data in the world, but if you don't know how to use it, and most importantly, interpret it, it's not useful. And I'll give you an analogy, right? You can have two doctors who go through, two surgeons, they do all the same training, they get the same degree, they both become qualified the same in whatever surgical field they're in, and yet there's still a difference between them when they go and cut open a patient and conduct a surgery. And that's because each one of them is taking on the data in front of them visually or through tests or whatever it is, and they're taking it on differently, interpreting it differently, and then executing on it differently. And yet they have access to exactly the same bit of information.
Yeah.
So I think that the way that we use it is that we have real deep expertise in data, right? So on our team, we've got people that are accountants by trade. We've got people that have property degrees by trade. We've got people that have been trained in data. So what it means is that we can look at the same ones and zeros that everybody else is, but then we can actually go and interpret it because we work in it every day and we have the technical knowledge behind us. But probably more importantly beyond that, we can then break it down for the average person. If you're a school teacher, you do not need to know about the intricacies of data in the property market. You just need to know what the end result means. And if you then trust that the professionals like us around you know how to do it, all you're concerned with, same as when you go to the doctor, is how are you going to fix me up? And that's the most important thing.
Yeah. And it is funny because when you think about how most people create their wealth in their life, most people it is through property, like of people you actually know.
Yeah.
If you're not thinking of, and this is not in any way advice or anything, but I just mean most people I actually know made their money through property. Even people that I know, because I used to be a stockbroker. Talk about.
No, yeah.
I used to work at Solomons Barney, and most people actually, even the wealthy stockbroking customers, made most of their money actually from property. So this is one thing you really do have to master, really, because it has the biggest change in your whole life.
I think in Australia, the two, I mean, these two things I'm going to say are not necessarily just about being in Australia, but I think in Australia, we really see it more than most is, firstly, the ability to leverage property is unmatched compared to any other asset class, because you can go and you can leverage up in some cases to 95 or even past 100% in the right circumstances to buy an asset worth hundreds of thousands. And the second part is that property in Australia is also very forgiving. So you can be leveraged and you can be very, very much over leveraged, but property is very forgiving, and especially if you hold it for the long term. So if you're smart and you put your head down and you bought even just 2 or 3 properties over your lifetime, you are going to have a hugely beneficial outcome at the end of your working life compared to, say, something like the share market, where if things don't go well, your stock can move plus or minus 20% a day, let alone over life. And if you buy at the wrong time, it is definitely not as forgiving.
Yeah. I think the problem with shares too is that, and this is again not financial advice, is that when you short shares, you can have unlimited losses.
Exactly right.
Whereas with property, if you lose money on that, you're still limited by the loss, or the loan, if you're leveraged.
Yeah.
But with and the other problem with shares is that if you short a stock, you can miss the they put in guardrails to stop you from if the shares bump, to stop you from hitting the triggers. But you can still they can still fall through the floor, or you can miss the guardrails, and so you really can have unlimited losses.
Yeah.
And people do lose a lot of money that way.
Imagine. Yeah. But I guess tying back into the data side of things, we invest very, very heavily on the data acquisition side of things. We spend upwards of hundreds of thousands of dollars a year into our data sources, our data platforms. I'm assuming that's where you're going. No, you go. No, you take it. I'll talk too much. You talk about it. We obviously invest in your data houses, like your CoreLogics of the world, your DSR datas and whatnot. But we've also developed our own proprietary software in-house where we've got access to the actual raw data. We know where all the data is coming from. It's absolutely powerful having that at your fingertips, but then also being able to interpret it efficiently as well.
Yeah.
Whereas a lot of people, a novice investor, might look at that and they just see numbers on a screen and don't really know how to navigate that.
Well, also because you know where the raw data came from, you're able to understand what the relationship of the data is to the actual property.
Yeah.
To the actual world.
Well, for us as well, the platform that we've built that's in-house, 100% proprietary, built for the first line of code up, we have a pretty close to over 500 million unique data points in our platform across decades of the property market, as well as other economic and demographic data. And more than anything, just gives us an unfair advantage, because what do you as a client have access to that can come anywhere close to what we do? So it gives us an unfair advantage, along with what I was talking about before, our ability to interpret and analyze it. So we've got the knowledge, we've got the expertise, and we've got the access. So how's that for an unfair advantage if you're just out there trying to do it on your weekend, after hours from work, whatever it might be? How are you going to compete in an environment like that? It's going to be very hard.
Yeah. And I mean, definitely it's definitely worth having access to knowing those things for the Australian market in particular, because it is very much a different beast than the other countries, isn't it?
Very much so.
Yeah.
Very much so. I think, in my experience, Australia has some of the best property data available, and some of the most accurate, and also some of the most timely as well. Like we get some data at fortnightly or monthly intervals, whereas in some other countries, it might be quarterly, it might be annually, and it might not be at the level of depth that we have here. So we have a really strong property market in all respects.
And I think we understand very well here at Atlas that Australia is not this homogenous entity where all markets are operating at the same rate.
Yeah.
Right? You've got your markets, you've got your sub-markets, and then you've even got your pockets.
Your micro market.
Yeah, your micro markets. And they're all going through their own independent phase of the market cycle.
Yes.
So if someone's going on an online forum and they're seeing where a hotspot is, how can they be sure without actually interpreting the data efficiently whether that market's actually primed to be investing in right now? Right? So because getting your location's very, very important, but getting your timing right in the market is just as critical.
Yeah. And how micro would you go then? Like, are you talking street level? Are you talking?
We look at data at that level, but good property investing, you need to have accessibility of data. And if you've got most streets might only have 20 houses on it, so you're not going to be able to get data. Sorry, you can get data to that level, but you're not going to be able to get actionable insights out of something at that level. But when you take data at a higher level and then you get down into the more micro analysis and understanding certain properties in certain areas and things like that, that's where that becomes powerful to know. But I'm a big believer in the 80-20 rule. If you can get 80% of property right, then the last 20% that you can't is going to be pretty forgiving on you. So if you can get the broad location, the pockets within that broad location right, the timing of it, your correct asset selection done right, that last 20% of should you have been on the left side or the right side of the street or whatever it might be, I'm a big believer, from what I was saying, that it's usually pretty forgiving in that nature.
Yeah. But due diligence, really, really important. Like we conduct our due diligence at 4 different levels. So we do it across the region, suburb, street, and asset level.
Yeah.
So, and I think we had a podcast episode where we spoke about this, where getting that boots on ground perspective as well is really, really critical.
And do you do that as well?
Yeah, we've got partners on the ground in all the markets that we invest in, because you might find that a market that is showing some pretty good data points looks great initially, but if you had spoken to, say, a property manager that's been established in that market for over a decade, and they've said to you that, yeah, sure, it's an okay suburb, in the morning, but once it hits past 5 p.m. or 6 p.m. at night, it turns into a bit of a crime scene.
Yeah.
So it's understanding what that's like.
Yeah.
To actually live in that area as well.
Yeah, I think for sure. And also just knowing the nuances of the area, like, Olympic cities and, all the different things that are affecting, what's happening in the future. It's definitely the nuances of the area. It's definitely good to know.
Yeah.
So say you identify an area, do you then only look in the areas where you've got people with the boots on the ground, or do you then put someone into an area once you've
We use a lot of different methods, because at the end of the day, we're not going to have a staff member in every location. It's just not financially viable. But thanks to things like technology, travel's never been easier. We make great relationships with partner businesses in the area to make sure that they're looking out for ours and our clients' best interests. We're able to cover the entirety of Australia effectively, but also not at a point where it becomes too cost prohibitive. Because otherwise, we might have to charge a client $50,000 to buy a property if it was, if we had certain things set up in certain ways. But I would definitely say technology has made a lot of what we do even better.
Yeah. That's good. And then what advice would you have for someone wanting to scale from, say, 1 to 2 properties intelligently?
I'd say the first thing, you probably want to review whether those 1 to 2 properties that you've got are actually doing what you want them to do in your portfolio to begin with.
Yeah.
So doing a review on those properties, really, really important, right? Like, what's that market like? What's the macro environment? What do the market pressure indicators look like in that market? Is it closed for short-term growth? Does it have the infrastructure and, you know, the fundamentals there to support sustainable growth? Understanding that, but then even getting more granular to things like, is it being under rented, right? Do you have a depreciation schedule on the property? Those kind of factors, right? Anything?
Yeah, so the one big thing, probably to go right back to the start, is what is your overall outcome you're trying to achieve? Because property number doesn't matter. I could own one property and it helps me achieve my goals if it's the right property and the right structures and doing the right things. Yeah, you take it, strip it all the way back to what's the outcome I'm trying to achieve. You can then reverse engineer that strategy and understand at 1 or 2 properties, how far away from my goal am I? What are the pieces that I need to put in place to get to that goal? And then you can get into some of the more tactical level stuff that Luke was just talking about, because you're then going to know you're making the right steps, not just moving for the sake of moving.
Yeah. I'm actually glad you brought that up because it made me think about something, because we have a lot of people that reach out to us, and a lot of the time they say, no, Luke, Lachlan, I want to buy 5 properties. I want to buy 10 properties. But to us, the quantity of properties isn't what you really should be focusing on. It's what those properties are doing for you, because you could go into the middle of bum F nowhere and buy 10 $200,000 properties. On paper, you've got 10 properties, but are they actually doing what you want them to do for you? Probably not.
Yeah.
Right. So it's about what are those properties actually doing, and are they setting you up to help achieve the outcomes that you want to drive towards?
And is there a question that I should have asked you?
Is there a question? Why do we like property so much?
Okay, why do you like property so much?
Yeah, you go first. You go first.
Sure.
Yeah.
Why do we like property so much?
Yeah.
I think we like property so much because I think property, compared to so many other assets, has its foundation in relationships, right? You have to have a relationship with a client. You have to have a relationship with a sales agent. You have to have a relationship with a broker and a solicitor. I think it really brings people together at a functional level. And then it also brings people together around the barbecue, the water cooler, all the rest, because we love property in Australia and it's such an easy talking point. And then I think when you bring that all together, it can give a real almost meaning to life, which might sound a little sad to some people to think that something like that can give meaning to life, but I think it really does. And so much of Australia is based around property, professions, financial markets, assets and wealth. But ultimately, into that last point, I don't think I've ever seen an asset in Australia that can set everyday people free, like from a wealth point of view and financial point of view, like property. And you don't have to be that smart. You don't have to be that successful, and you don't have to make that much money. And it doesn't mean you're going to retire at 40, even if you started at 20. But by the time you hit 60 or 65, even if you've worked by all measures a pretty ordinary job and you've lived a pretty ordinary life, you can have an amazing retirement, which is more than what most people can say.
Yeah.
My answer is not going to be as comprehensive.
It's all right. It never is. We'll forgive you for it.
One word in response: leverage. Like, I think leverage is the thing that I really love about property investing. In terms of working in the space, I think unlike a lot of other industries, if you work in the property space or the mortgage broking space, you actually develop a skill set where you can actually better your own life as well as other people that you work with. And I think that is something that's really, really special about working in this industry that I love.
That's a good answer.
That's a good answer.
I like that.
It's almost by accident, though.
Yeah.
Because you see so
Absolutely.
many people doing it, you just end up doing something and then,
There are so many accidental millionaires from property that never would have made any wealth if you look at their education, their career, their family life, their childhood. They should have never become accidental millionaires by any measure of by the book. And yet somehow they have. And like I said, they are so much better off for it. And they may have even set up their kids and generations for it too.
Yeah. My question is,
you focus on buying investment properties for leveraging. What about people buying their first property and maybe it's an owner-occupied? Would you or have you helped clients, because there are buyers agents that help clients buy their very first property to live in? Because you can obviously leverage that or use the equity in that to buy down the chain. Are you doing that? Are you considering doing that? Is that a space you want to play in?
You take it.
So something that we say to everybody when they come and have a conversation with us around, should I invest in my owner occupier or get into it and then leverage it into something else, is it can absolutely work for you. And for everything I just said, property is very forgiving and you can create some incredible wealth. But earlier on in our chat, I also talked about opportunity cost. And there is a big difference between an asset that has been purchased for a pure investment focus, pure investment purpose, and has had that lens applied to it from the very beginning, versus an asset that has been overlaid to whatever degree with an emotional owner-occupier type of mindset. And whilst it absolutely can work, and a lot of people have gone out and bought their own home and it's improved in value, and maybe they've taken equity to go into another property, or they've just sold that and done something else. If you go and you try and buy an investment property, but with an idea of maybe I'll live in it one day, then you're going to make sacrifices on the investable characteristics, because you're going to be thinking about, could I live in this? And if you flip it and go, well, I'm now going to buy something to live in, and then if I could get something that's got some decent investment attributes to it, that'd be good too. You're now going to be looking at a property, you're going to be feeling 95% in love with it, but that last 5% is going to make it really hard for you to live in it long term, because you sacrificed something that was important to you because it may have made better sense from an investment lens to do. So I always say, separate the two out and you'll get a much better outcome.
So what would you recommend then? Not recommend, but give advice. But if someone's looking at buying their first home, what would you say then?
Personally, I would say don't do it. I would say don't do it, because at the end of the day, most people can go and rent where they'd prefer to live for cheaper than the mortgage on the same property. You can take that, you can buy investment grade assets, which if you're doing it right, should return a better result than the owner occupier's performance. You can use that to leverage into more properties, because you also have tax deductibility of debt at that point. And then you are likely to be able to put yourself in a much better wealth position in 20 years time, compared to if you buy your own owner occupier and you might have capped yourself out and now you can't go and do anything else.
The only exception that I would say to that is if this was an individual that only wanted to buy one property and they didn't want to, they didn't have any ambition to be able to scale a portfolio. They just wanted one property and that's it. Maybe buying an owner occupier is the right way for them, because later down the road, they're not going to be liable to pay capital gains tax on that property. Right. So if you compare, say, someone buying an owner occupier versus just one investment property and renting for the rest of their life and just keeping that one investment property, looking at the performance of those two.
I would definitely agree with you. I just think that honestly, if I was somebody like that, I have no idea why you'd want to do it though. I'd say go put your money elsewhere. I think you're 100% right.
Yeah.
Like, I think it's just, again, it comes back to, why are you investing? Nobody's investing because they want to own properties. They're investing because they believe properties give them something.
Yeah.
And usually that's some sort of financial return. And I feel like you'd be hard pressed to find anyone. Oh, sorry. You know what? Well, I know there's people because we've spoken to them, right? But for those people, I always find it interesting because there's no sense in doing that, right? Like it doesn't, there's no real financial result that you could probably get from property.
Yeah.
For all the costs that come with ownership and things like that. You probably would be better just throwing in shares or a managed fund or something like that.
Yeah.
Rather than the burden of owning single.
Sometimes too, I mean, you've got people who want to buy an owner-occupied, but they can't find something that they can afford in the location.
Yeah.
And they can only afford one property. They might be a first home buyer, but they've opted to buy an investment because it's cheaper, they can afford it, and they're still building their wealth.
Yeah.
Yeah.
So, and they've just bought in another state.
Yeah.
Had that.
Yeah. Well, thanks so much, guys. This has been really interesting.
Thanks for having us on. Yeah. Appreciate it.
Thanks, Lachlan. Great insights of how smart investing really works behind the scenes. Coming up next, I'll be joined by Julianne Zammit to dive into the finance side, specifically how your lending structure must match your investment goals.